Welcome everyone, and yeah, excited to have our event here with Dan Roberts from Savvi Legal. Today, we're going to be talking about how to prepare your venture for financing, and this is an event across our different communities with Prepare for VC, Boston New Technology, and the Startup Grind Boston chapter. So, just a quick background on each of those. Prepare for VC, we're basically a venture hub that hosts cohort consulting and community based support for early stage technology founders. Um, and yeah, we have a variety of programs and offerings, and we're going to have a big event series coming up in Boston in a few weeks called the Startup Spring. Um, Boston New Technology is an organization that's been around 11 years now and really focuses on sharing and showcasing different events, opportunities, and ways to bring the local startup ecosystem together. And we've actually been expanding into other chapters now with a Rhode Island chapter. We have Mike, who's on the call, as our Rhode Island d- director for the new chapter, and we'll be launching in a Philadelphia and DC chapter there as well. And then, yeah, Startup Grind is an organization started out in Silicon Valley, has a big conference coming up next week as well, in California, and there's 500 different chapters with local communities around the world. And yeah, we're really excited. We Prepare for VC had partnered up with Savvi Legal. We actually have on our resources page on the website here. We actually have a link to special offer from the team for a discount on the support services that their team offers. And we've really enjoyed all the conversations with Dan and Connor and their team on how they can help make the legal process a little bit easier and less scary for all the entrepreneurs. So yeah, Dan, really excited to have you here. You have an impressive background. I'll let you kind of kick us off, share your story, and walk us through how to prepare your venture for financing.
Awesome. Really appreciate it, Jason. Really excited to be here. I'll go ahead and share my screen here just so that we can kick off. And give me the thumbs up if you can see that.
Not yet.
All right. How about now? No?
And while we're waiting for that, feel free to everyone introduce themselves. Feel free to share what you're working on, or add your LinkedIn or other messages in the chat as well to connect with each other.
All right. The share screen button just went blank, so it's not allowing me to share screen anymore. Hold on here. Apologies for this delay here.
Yeah, if it's not working and you want to just shoot me, I can share it from my side if you want to
Okay.
email it.
I'm sharing it with you, Jason, right now, if it doesn't pop up. Oops.
Oh. Apologies for that. We'll get back up here in a second, and yeah, hope everyone looks like yeah, everyone's sharing some messages in the chat. So yeah, looking forward to having everyone connect with each other as we kick off and get started here. Well, there we go. Hey, Dan. Yeah, we got you back up now. Oh, perfect. All right. Yeah, I'll share a screen and yeah, we can get started.
Here, let me see if this works one more time. It keeps giving
sure.
me keeps giving me an error when I try to share my screen, but let me see if I just tried one more time and let's see if it worked. Let me know if it pulls up. No? Wait.
Something is pulled up. Yeah, perfect. We can see it.
All right. All right. Apologies for the delay there, but let's go ahead and dive in here. So today we'll be talking about preparing for venture financing in the current funding environment and what that looks like. Some things that you guys as founders should be aware of, things to keep in mind, and really, this isn't a 101 level course. This is probably a 201 level course. We're going to assume that you know certain things about entity formations, how to issue equity, things like that. We're going to talk about, assume that you're at the point where you're ready to raise money and the things that you need to know going into that process. So that's where we're at in what we're going to be talking about. A little bit about my background. So I'm a venture attorney. I've been doing this for over 12 years, worked with hundreds of startups on hundreds of financings. I've actually worked in-house at a venture fund, worked for 3 years doing all the fund work for a big international venture fund. So I know exactly what they're looking at from the investor side. Then I went and worked in big law doing an international corporate practice where I worked with hundreds of startups on the company side. So I know what it's like from a venture attorney's perspective, what kind of things you guys need to be thinking about from both the, how investors look at things and how the companies look at things. Also, I just want to throw out there that I myself am a technical founder. I've got a legal technology company, Savvi. I'll be talking about it a little bit here during the call. And I know what it's like to have to raise money, know what it's like to go into that process, and know what it's like to have to go and talk to investors and what they're looking for. And so that's my background. That's a little bit about why I'm qualified to speak on this subject. So let's talk about the high level agenda here. So we're going to have, first of all, we're going to dive into term sheets. What you need to know about term sheets, what kind of terms are going to pop up there, how you need to be negotiating those terms, and things that are negotiable, helping you understand that high level, the pieces of the term sheet that need to go into your, your thought process. We're going to talk about the due diligence process. That comes after the term sheets. It's what the investors are going to be asking for before they invest, the things that they want to look at and do a deep dive in on your company, that check the boxes to make sure that you are what you say you are. So we're going to talk about that due diligence process. That usually comes in between the term sheet getting negotiated and the closing process. And so then we'll talk about what is that closing process? What are the documents that you're going to see in a venture financing? What are the importance of those documents? And how do you get from, point A to point B being getting the money in the door, and having the actual, the venture financing closed, where you're off to the races. And then we'll spend a very brief segment talking about those post-financing considerations. Now that you are a venture-backed company, what things do you need to keep in mind now that you have investors that are venture funds? And so that's kind of the agenda here. So we'll go ahead and dive right in. Let's talk about term sheet basics. So first of all, I'm going to share a graph. When I talk about term sheets, we usually talk about term sheets in terms of the type of financing that you're going to do. There's different types of financings that are options when you're a venture-backed company. These financings range in complexity. The simplest type of financing that you might see would be a SAFE. So that is a very, very simple, very standard financing event. The most complicated that you're going to see, at least before you get into more private equity sized rounds, are what we call an NVCA financing. So NVCA, that's the National Venture Capital Association. They've put out a set of documents that are pretty standard for venture financings, especially Series A and beyond, that are a little bit more complex, but they're still standardized, which is nice compared to, let's say, 10 years ago or 15 years ago, when every law firm had a different set of templates. It made the financing process very, very tedious and complex to negotiate, whereas the NVCA documents are a standardized template set. Make closing simpler than they were, but it's still complex. So what you see, ranging from a simple SAFE to a more complex NVCA round, you're going to see a delay in how long it takes to close your round. You're also going to see an increase in transaction costs, specifically legal fees. So we're going to talk about why that might be, but I just want to give you this kind of intro, this visualization of, hey, from simple to complex, why you might want to push your investors towards a more simple route if you can, just because it will increase costs and time to close. And so we'll talk about these different types of financings here in the coming slides. So the first type of financing we saw on that chart, we've got SAFEs, and convertible notes are the more simple types. Those are what we call a convertible financing. We use that term because in essence, they're giving you money in exchange for a document that is convertible into equity, into stock at a later time. So it's a convertible financing. They're getting something that's convertible into stock. Both a SAFE and a convertible note fall under this categorization. SAFE is an acronym. If you haven't heard that term, you will probably hear it quite a bit in your startup journey. SAFE means simple agreement for future equity. Very, very cut and dry about what it means. It's simple. It's for future equity. It's convertible. A convertible note is a little bit different from a SAFE in that a convertible note is a debt instrument. It has interest and it has a maturity date, and it'll show up in your liabilities section on your balance sheet. So those are the kind of differences between SAFEs and convertible notes. Other than that, they're pretty similar in how they work. They both convert into equity. And what you're looking at is, how do those instruments convert into equity? If you're doing a convertible financing, the key terms you're going to focus on are those conversion terms. And so if you're looking at a term sheet or you want to generate a term sheet, or an investor has given you a term sheet, for a convertible financing. These two terms are going to be what you're looking at: valuation cap and conversion discount. Now, what do those mean? A valuation cap is basically setting the value of your company at which this investment will convert into equity at. And so it sets the price for the conversion. So if you are raising, let's say, $1 million on a safe, and you get a $10 million valuation cap, then that $1 million will convert into equity based on a valuation of $10 million. Now, there's a few different ways to set a valuation cap. There's a pre-money and a post-money cap. I'm not going to dive really into the specifics there. We don't have enough time to dive in super deep, but basically the post-money with a post-money valuation cap of $10 million, it includes the $1 million investment of the safe. And so 1 million of that 10 million is reserved for the investor. And so they're going to get 10% of your company. If it's a pre-money valuation cap, it doesn't include the 1 million. It's looking at everything else before the 1 million comes in. And so their 1 million comes in on a post-money basis of a pre-money valuation cap. It's a little confusing, but the percentage that they'll get is a little bit different. Pre-money is a little bit better that for the founders, all other things considered, all other things being equal. So if you can get a pre-money valuation, that's in your best interest. But most safes these days are post-money. The standard Y Combinator safe, Y Combinator is the group that made the safe popular and actually invented the safe. Their current safe is a post-money safe. The other term that you'll see in a safe is a conversion discount, or in a convertible note. A conversion discount, it doesn't set a price that the safe or the convertible note will convert at the outset. What it says is we'll look at whatever price you sell shares at in your next financing, and we'll get a discount off of that. And so if your next financing is a $10 million financing, valuation financing, the conversion discount of 20%, which is a pretty standard conversion discount, will set the price for the safes with convertible notes at an $8 million valuation, a 20% discount off of the priced rounds valuation. Or if it's a $50 million valuation, they're going to get a $40 million valuation for their conversion. So 20% off of the 50 million. So the conversion discount allows for, if your company does really, really well and your next round's valuation is a lot higher, you're going to take less dilution as the founders if your investors only have a conversion discount on their convertible. Valuation cap, again, it sets the price. And so regardless of how well your company does, your next round might be a $50 million round or a $100 million round. But if this valuation cap is at 10 million, that's what the convertible note investors or the safe investors will get. And so that's better for the investors. A lot of times you will see both of these terms in a convertible note or a safe. And in that case, the investors will get whichever one gives them the better conversion terms. So that's how those work. Let's talk about preferred stock or equity financing, what we call a priced round, because you're actually setting a price on your shares and selling shares of your company. Now, most equity financings are preferred stock. Why? Preferred stock allows for more complex investor rights. They have liquidation preferences, certain governance rights that you can attach to them that allow them to distinguish themselves from the common stock, the shares that the founders have. Most NVCA financings are preferred stock. There is another type of preferred stock financing that is somewhat popular. It's gained some traction, and it's simpler than the NVCA. This is called what we call the Series Seed preferred stock financing templates. They were popularized on a website called seriesseed.com about 10 years ago. Now that website doesn't keep those templates up to date, but you can get them through pretty much any law firm can generate them for you. If your investor's okay with the Series Seed template set, that's going to be simpler than the NVCA, but both of those are preferred stock financings. So common stock, some founders will say, well, can I sell shares of common stock? Please don't. It's going to ruin your ability to issue stock options at a discounted exercise price. So you usually don't want to, because it hurts your employees who are going to get stock options. And in addition to that, most investors don't want common stock. They want preferred stock. So most equity financings are going to be preferred stock. Now, preferred stock has a lot of terms that we're going to dive into here, but that's the high level. So again, here's a slide. We'll be able to share these slides with you so that you can review these. This has a little bit more breakdown of pre-money versus post-money. You can compare that. We're not going to dive into that right now. Some scenario analysis of how those are different. Let's move on to talking about investor rights. So we've talked about types of financings, convertible versus preferred. Now let's talk about the types of investor rights that you might see in a term sheet. So there are two main types of investor rights. There's contractual rights. These are granted in a contract. The contract can be between the company and the investors, or between the investors and other stockholders or investors. And so these contracts are what establish these investor rights. The rights granted by a company, these contractual rights are often something that an investor might ask for in a convertible round. The rights granted between investors and stockholders are usually only in an equity round. And so we'll talk more about these types of rights here, just giving you a very high level breakdown so that you know what we're talking about. The stock-based rights, because these are rights that are attached to the shares, they're only going to pop up in an equity round. They won't show up in a convertible round. Again, these are tied to the stock. These are more economic and control or governance related types of rights. So those are high level overview of investor rights. So let's dive into these investor rights. Let's talk about the stock-based rights first. So stock-based rights, as I mentioned, they're tied to the stock. And the easiest way to understand these is comparing what rights common stock has and what rights preferred stock might get. So the first type of rights that we're going to talk about are the economic rights. When you're the common stock is typically held by founders, employees through a stock option plan, or advisors might get common stock. But the common stockholders, their economic rights are typically what I call the residual rights. What this means is anything that is left over after the company has paid off all of its debt and paid off all of its preferred rights, in the scenario A, where the company does really well, there is a lot of upside after all the debt and preferred stock. Oh, sorry.
Yeah, I can't hear you.
Looks like I'm stalled. Can you guys hear me now?
Yeah, you're back.
It's lagging behind. I'm hearing before now.
All right. How about now?
Yep, you're good. Oh, we lost the screen share, but
all right. Are we back?
Yeah, we're back. Hey, there we go.
All right. Can you guys hear me now?
Yeah, we can.
All right.
We can't hear you at all now.
Can you hear me, Jason?
Yeah, we can hear you. Just lost the screen share.
Okay. I just tried to reshare that. Let me see if it pops up here in a second. While that pulls up, I'll kind of jump back to the beginning of this slide. So we're talking about stock-based rights, specifically economic rights. The economic rights are with common stock. Common stock has what I call the residual economic rights. Again, what that means is if the company does well, they're going to have anything left over after paying the debt off and after paying the preferred stock off. If the company doesn't do very well, the debt and the preferred is going to take all of the liquidation value, and the common stock is not going to have very much. And so the common stock has a lot of upside, it has all the upside, but it doesn't have any downside protection. So that's kind of where the common stock's economic rights lie. When we compare this to the preferred stock rights, they have a preference. So the preferred stock will get paid before the common stock gets anything, but after debt. So what that means is they have some downside protection. This is why investors like preferred stock. Now, in a term sheet, what does this mean? What are the terms that you look for to make sure that investors' preference is just a standard preference? Well, the first one is, what multiple does their preference equal? Most venture deals these days is a 1x liquidation preference, which means their preference is equal to the amount that they've invested, 1x. If things don't go well, the preferred stock will get paid back their money that they put in before common stock gets anything. Just 1x. They're not getting a multiplier. They're not getting an interest rate usually. They're just getting their investment amount. That said, there's also another term that you want to pay attention to here, and that is that participating versus non-participating liquidation preference. So what that means is, if there's a participating liquidation preference, then the investor will get their 1x amount, and then they will also get whatever common stock gets paid on a per share basis. That's like double dipping. And so it's pretty uncommon these days. The more common scenario is non-participating preferred, where they will either get paid their 1x amount or whatever common stock gets paid in the residual, whichever is greater. And so they get that upside. They have their downside protection, but they're not double dipping. And that's typically what you're going to see in your term sheets. If you see anything other than non-participating 1x liquidation preference, you should feel fully within your rights to push back and negotiate for 1x non-participating liquidation preference. So that's the term you're going to look at in your term sheet that sets that preference. I see some questions.
Yeah, Dan, I was just going to address, had a couple of questions around the same space here on, why founders are receiving common stock versus preferred and how that is structured out.
Yeah, that's a great question. And I mean, obviously, if the preferred stock has a preference, why don't founders just go and get preferred stock? And it's a valid point. But what you're going to see is that attempt to give yourself a preference is pretty much going to be undone by any venture capital group. They're going to say either, well, let's convert you back into common because we need to know that we'll get paid before you get paid anything. Either that, or if you do have a founder preferred set of class of stock, which you do see at times, the investors will just say, okay, that's okay, but we're going to have a more senior class of preferred where our liquidation preference gets paid before your liquidation preference. And so you don't actually accomplish much by setting up a founder class of preferred stock because, again, VCs will just come in and be senior to you no matter what, and the liquidation waterfall will fall out the same way. So you can do it. It's just investors don't like it. They want themselves to get paid back before you get paid anything. And that's just going to be part of their terms. And so as much as you'd like to get creative, you might end up having to undo all of your creativity, or your creativity may be just for naught because the investors come in and say, well, we're going to have to get creative ourselves to sit on top of whatever you've done to get yourself some creative rights. So for that reason, I typically just recommend that founders just go for common stock. Getting creative adds costs to your formation, and it doesn't really add a lot of value because, again, VCs are thinking about economic rights in a specific lens. And if you've taken your economic rights and turned it into something else that's outside of what they're used to, they're not going to like that. It might hold up closing and you might have to just pay money to undo it. Or they're going to get creative, like I said, and get their rights no matter what. So that's kind of where that comes into play. So that's from the economic rights perspective. Governance rights, common stock has basically whatever rights are required for stockholders to have by state law. In Delaware, that's, hey, stockholders get to appoint board members. You get a vote on any charter amendments. If the company's getting acquired or you need to do a merger, the stockholders have to approve that. That's just the bare minimum, and that's what common stockholders get. Preferred stockholders will then typically add on top of that what we call a protective provision or veto right, where the company can't take certain actions without the preferred stock consent. So these are very important to pay attention to. It's very hard to negotiate down from a kind of a base level of these, but if they get too aggressive, you can absolutely push back. Those protective provisions typically are certain things like, hey, you can't raise future financings that might dilute the investors down unexpectedly or out of the ordinary. And so they'll have a consent right or a protective provision around future financing events. They'll typically have it around a merger or an acquisition where even though they might not have majority control, the investors typically will have 20% or less, at least in your seed or Series A financings. Because they're a minority stockholder, they still want to be able to have a say whether an acquisition happens. Especially, some founders kind of get creative where they structure an acquisition deal where, hey, let's pay an executive bonus of $20 million that goes to the founders, and then pay the stockholders $1 million. And like those types of things, investors don't want that to happen. That basically undoes the total the upside that they're trying to calculate for in their term sheets. And so they just need to have protective provisions that don't allow founders to cut them out of the waterfall, out of cut their piece out of the pie. And so that's what these protective provisions are meant to do. Sometimes you'll also see certain protective provisions that have impacts on your ability to operate the company. And those are where I think you should definitely focus on your pushback. If they have a protective provision that says you can't raise any debt, well, you should have at least some freedom to raise a certain amount of debt, up to, let's say, $250,000 so that you can get a line of credit to run your business, things like that. That's where you can get more, negotiate on the protective provisions. So if there's protective provisions that impact your ability to operate the company, to set salaries for employees, to increase the option pool, to issue stock options, that's where you should focus your negotiations in the term sheet on the protective provisions. Other stock-based rights are conversion rights, where the preferred can convert into common stock. This is where they get their ability to participate in the residual economic rights. So all of that upside that the residual has, the preferred upside is contained in their ability to convert into common stock. And so that is why that's important to investors. Usually it's a 1-to-1, one preferred stock into one share of common stock basis. But that ratio can be modified through a term that we call the anti-dilution protection of the preferred stock. Now you will see this in term sheets. It sounds scary, but it isn't actually that bad if it's the standard anti-dilution rights. What this means is if there's a down round where you sell shares at a price per share lower than the investor bought their shares, their conversion ratio into common stock will be adjusted in some way to account for that down round, that you overpriced their shares, basically. And so that standard anti-dilution protection is called a broad-based weighted average anti-dilution protection. That's what you're going to look for in your term sheets. If it's a broad-based weighted average anti-dilution protection, that's fine. If it's narrow-based weighted average or full ratchet, that's where you push back. This is almost a standard point across the board. 99.99% of deals have broad-based weighted average. If there's anything else, you're at liberty to negotiate it and change it back to broad-based weighted average. That, again, what it does is it adjusts their conversion ratio so their participation in the residual is a little bit higher than a 1-to-1 basis in terms of preferred stock to common stock. So that's how that works. Sounds scary, but it's not that scary. Usually doesn't come into play. If the company does well, it won't come into play. And so it's not something you can take out. It is something that the investors will require. The other types of rights that are stock-based rights are dividend rights. Sometimes you'll see preferred stock ask for a preferred dividend right. Usually you don't see this. If you do see it, it's okay as long as it's when, as, and if declared by the board, because then as the board, you just don't declare dividends. Usually startups don't pay dividends, and so a preferred dividend won't come up as long as it's non-cumulative and it's only when, as, and if declared by the board. So those are, if you do see a preferred dividend, make sure it's not cumulative and it's got this when, as, and if language. So that's what you're looking for in a dividend right in the term sheet. All right, so those are your stock-based rights. Let's talk about those contractual rights, the investor rights that exist through contract. So the first one that I'm going to talk about are the rights granted by the company in a contract to the investors. These rights fall into three major categories. The first is registration rights. What happens if you go public? If you're never going to go public, this is never going to come up. But if you do go public, the investors want to know that they have the right to register their shares on the stock market so that they can sell their shares on the stock market. Pretty standard. It's a lot of language. There's like 10 pages in an investor rights agreement that talk about registration rights that are almost never negotiated because they're so standard. And it's just investors will get the right to register their shares after an IPO. So not really anything to negotiate there or worry about, as long as you do want to have a lawyer look over those rights in the term sheet to make sure it is standard. But again, 99.999% of the deals are very standard in the registration rights space. The other rights you do want to pay attention to are, what are the information rights? The rights to get information that the investor has. So you will see things like, hey, I want monthly updates, or I want quarterly financial statements, and I want an annual financial statement. The quarterly and annual is very standard and basic. Totally okay for you to give investors that. You want to steer away from monthly updates if you can, because as a CEO of a company, monthly updates can get tedious, and that takes 1 or 2 days of your time just to put together the information reports for investors. So that's what you want to pay attention to. The second is, who gets these rights? Often these rights are reserved for what we call major investors. A major investor is a defined term in your investor rights agreement that you can set. It's negotiable. Maybe it's $250,000. Anybody who's invested that much. Maybe it's $500,000. Maybe it's $1 million. You can set the major investor threshold in your term sheet to whatever makes sense. Usually it's like the lead investor gets it and maybe nobody else, or the lead investor and some other bigger investors. Sometimes you'll also see people get board observer rights. It's okay to give people board observer rights as long as you're not giving everybody board observer rights and you feel like they're a value add in your board meetings. Sometimes you'll have a lead investor who has a seat on your board and a board observer right, so that they can have more people involved in the board than the number of board seats that you negotiate for. The last class of company granted investor right is a participation right, often called a pro rata right or a right of first offer, meaning that in your next financing, you will give your investors the right to invest in that financing. So they're right to participate. Usually it's their pro rata amount. So if an investor has 10% of your company at the end of your seed round, then you would give them 10% of the option to invest up to 10% in the Series A round, because that way they'll keep their pro rata ownership the same. Again, this can often be limited, or usually is limited, to major investors, whatever you define that as. So those are the company granted investor rights. The other types of contractual rights are rights between investors and each other, or investors and the other stockholders, like the founders. So one of these rights is a voting right. This voting agreement entails everybody agreeing to vote their shares in a specific way to accomplish an agreed upon term. One of those terms is, how is the board going to be composed? After your seed round, the founders might have 2 board seats and the investors might have 1 board seat. Where after a Series A round, the founders might have 2 board seats, the investors might have 2 board seats, and there might be an independent director. All of that is set out in the board designation rights of a voting agreement. And everybody agrees to vote their shares to appoint the board members that are designated in this term. So pay attention to this in your term sheet. How is the board structured? Typically, when you hear the stories of a founder losing control of their company and getting fired, kicked out, whatever that is, it's because they lost control of the board, and that board voted them out. And so that is the biggest control issue of your company is, do you control your board? Pay very close attention to that in your term sheets. Try to avoid giving up majority control of your board if you can. That said, if you can't, try to at least have equal seats as the investors with an independent director that you get to have a say in, so that you know that you can pick an independent director that you're okay with and that will hopefully side with you on most things. So that's the board designation rights, a very important term in your term sheet. The drag along right basically says that everybody will vote to approve a sale of the company if a certain approving group authorizes that sale of the company. That's how a drag along works. That whoever's in that approving group authorizes the sale, everybody else has to approve it. So what you pay attention to is who's in the approving group. It usually has the board. Obviously, the board has to approve any sale of the company. It will usually have either the lead investor alone or a majority of the preferred has to be in the approving group. And then what you'd often see is that in the initial drafts of a term sheet, the investors will not include the founders in the approving group, which means the investors can approve a sale and drag along the founders to a sale of the company that they don't want. This is negotiable. Whether the investors allow you to include the founders in that approving group or not is, it's 50-50. Some investors are okay with it. Some investors don't want you to be in there. And it's a deal killer for them. So, but if you see it in the term sheet, you should push back and see what they think. You don't get what you don't ask for. And this is one of those things that sometimes you get it, sometimes you don't. And maybe for you, it's a deal killer. Maybe you don't want to be able to be dragged along if the preferred stock approves a sale. Because remember, preferred stock has a liquidation preference. They might approve a sale where they're getting their money back and common stock doesn't. There's nothing left over for the common stock. And so it should be a concern for you. You should think about it and you should push back as hard as you can. But at the end of the day, whether the investor accepts it or not is up to them. The other type of rights between investors and other stockholders are transfer rights. What happens if a stockholder wants to sell their shares or transfer their shares? If you're selling your shares to, giving your shares to, if a stockholder dies and gives their shares to their wife or their kids, this usually is an exempted or an exempted transfer, so it doesn't trigger these transfer rights. But if a founder wants to sell their shares, they get somebody coming in and saying, I want to buy 1,000 of your shares at $100 per share. That would be awesome for you as the founder, but the investors want to allow you to offer it. They want the opportunity to buy that first. And so if you do get a third party who's going to buy your shares at $100 per share, the investors have a right of first refusal. So you have to go to the investors and say, hey, I've got a buyer. The price is $100 per share. They're going to buy 1,000 shares. Any takers within our investor group, you have to give it that right or that offer to the investors who have that ROFR, the right of first refusal. Then if nobody takes it, investors will usually have a co-sale right or a tag-along right. And that means that they might say, oh, $100 per share, we really like that. Let's go ahead and we want to sell some of our shares. And they'll be able to tag along. And of those 1,000 shares that the third party is going to buy, the investor might be able to put up, if they're 10% holder of the company, they can put up 100 of those shares because that's 10% of the offer. And so that's what the right of co-sale does, basically allowing them to buy your shares, buy shares of other stockholders before a third party does, keep it in the family, so to speak. Or if the deal is really awesome, be able to sell some of their shares as well. So that's how the transfer rights work. Those are all of the investor rights that we're going to talk about. There are some other terms that you will see in term sheets that you should definitely pay attention to. They're not investor rights. They are more geared towards founders' dilution and founders' rights. And so the first of those is the option pool refresh. What percentage of the company or how many shares does the investor require you to set aside in your option pool on a pre-money basis? So basically, if they want you to increase your option pool, that you're going to have to do that before you set their price per share. And that's going to dilute the founders because it comes in on a pre-money. So that option pool refresh, you want to keep it as low as possible. 10%, if you can keep it at 10%, that's pretty standard. Maybe you don't need 10% and you can convince the investors that you only need 5, 6, 7, 8%. If you can do that, that's awesome. Most investors will want to see at least 10%, maybe even up to 13. I'd try to keep it at 13% max. 10% is what I like to push for. And most investors are okay with that. But again, the higher that number is, the more dilution you as the founders take because it comes in pre-money and dilutes you. So that's something to pay attention to. The other is, are they requiring the founders to refresh any of their vesting schedules? Sometimes you'll see a term sheet say founders vesting resets completely, 100% full reset, 4-year vesting schedule starting the day that we close. You can push back on that. You should push back on that. You should get some credit for the work you've done. And but that said, if you're fully vested going into a venture round, it's going to be a deal killer if you don't agree to some vesting. They need you to have skin in the game. They need to know that you're going to stick around because you need to continue vesting your shares. And so push back on that. Maybe try to push for half of your shares being staying as fully vested and the other half being subject to the new vesting schedule, something along those lines. But it's up for negotiation. It is something you need to pay attention to in a term sheet. So that concludes our term sheet basics. We took up a lot of time talking about that. We're going to breeze through the rest of this pretty quick. But again, I'm just showing this graph. The safes and the convertible notes, you're not going to have a lot of the contractual investor rights. They're not going to have the stock-based rights. And so there's not as much to negotiate on those. That's why they're simpler. That NVCA round, that's where all of those rights are included. And that's why it's a little bit more complex. It costs a little bit more to negotiate. So that's why just revisiting this graph. All right, let's dive in really quick, talk about due diligence. What is due diligence? This is where investors want to make sure that you are what you say you are before they give you their money. So there's kind of 2 levels of diligence, or maybe 3 if you want to break up business diligence into 2 types. So business diligence is, hey, let's look at your business plans, your sales model, your executive team, your market size, potential market availability. Let's look at all of that and make sure that we think that this business is an investable business. Then there's the financial diligence. Often I kind of like to categorize that as its own thing because it's, hey, shows your financial statements, shows your projections. What is your, LTV to CAC ratio? What's your burn rate, your churn rate, all of these financial metrics, and sales projections. What's your pipeline look like? What's in your accounts receivable, historicals? That's all, them understanding, is this a potentially profitable business? So the business diligence is looking at whether the business model would work. The financial is whether you're going to be able to, if you take their money and build out a business around your financials, is it going to become profitable? Or, they're going to look at those 2 things. A lot of times those are happening before you get a term sheet. They won't give you a term sheet until they've checked these 2 boxes. After you get a term sheet, they're going to look at all of your legal documents. They're going to look at your organizational documents. Are you in good standing? Do you have good bylaws, etc.? They're going to look at your governance. Do you have all of your board and stockholder consents? All of your minutes from all of those meetings, if you have done meetings. They're going to look at your team documents. Have your employees signed IP assignment confidentiality agreements? Very key. And often a foot fault that founders aren't doing from day. You should be doing this from day one. The founders should sign an IP assignment confidentiality agreement, as well as every single employee. So have you done that? If not, there's a question there. They're gonna have to dig in and see, well, if a team member didn't sign one of these documents, how key were they? Did they develop key IP? Did they have key information access to key information that should be confidential, that they're not subject to confidentiality obligation? They're going to look at that. They're going to look at non-competes. If you're in a state where non-competes are valid, now Massachusetts, it's pretty hard to get a non-compete to be valid, and so it might not apply to you. But if you're outside of Massachusetts or California, most other states allow for a non-compete, and so investors are going to look at that. Or at least their attorneys are going to look at that. Most of this legal due diligence is happening at the attorney level. The investors' attorneys are looking at these things. Then they're going to do a really deep dive into equity. Now, the cap table is probably something they asked you for up during the financial diligence, like we want to understand who owns what. But in the legal diligence, they're going to look at every single line on your cap table and make sure there's an approving board consent, there's a signed equity agreement, make sure that the vesting schedule makes sense, etc. So they're going to do a deep dive into your cap table and your equity. And this is often where founders have failed to document things and where it messes up your financing the most, because of equity grant that doesn't have a board consent or a signed equity agreement didn't happen. And you've got a line item there on your cap table that somebody thinks they own shares, but they don't. And now you got to clean it up, and it's a big mess. It can have pretty big tax implications as well for those people. So there's a lot to look at on the equity line. And then they're going to look at your other things like what are your client agreements, your IP, your terms of service on your website, what's your privacy policy, what's your trademarks, do you have patents? They're going to dive into that. So all of that, very, very time consuming if investors are looking to check all those boxes. I will say in most safe or convertible financings, they're not looking to check all these boxes. They're just checking, business and financial and high level legal. They're not going to do a super deep dive because they know that that's going to happen down the road when they're safe converts. One of the big reasons why a safe financing is so much simpler is because due diligence is simpler. But in a preferred stock financing, expect for all of this to be looked at. So best practices, keep things simple. This is where one of those things where, hey, I want to do a founder preferred stock, or I want to do a really creative vesting schedule. This is where it can hold you up because they go do a deep dive into your documents and you've gotten creative and now you've got to undo it or they've got to revise something and it's going to delay your closing. So keeping things simple is going to lead to a smoother due diligence. Next after that, maintaining your corporate record as you go along, keeping an up-to-date data room so that you can do that. And this is Savvi, which is the company that I founded, is a legal technology platform that allows companies to have automated templates for all of these legal things, equity, team documents, organizational documents, board documents. You have templates that you can use, and it's creating a data room for you as your company goes along. And so whether you're doing an entity formation or a safe financing, we have those templates, and then you can create your data room and share it with investors very easily. So that's where we come into play. And like Jason mentioned, there's a discount there that you can get access to. I'm going to breeze through this closing process because we've talked a lot about what goes into this with the term sheet. Basically, the closing process is after the due diligence has happened, you just got to document those terms that we talked about into documents. And so we're going to talk about the documents that are going to get drafted. And so the first document is the investment document. This is the document that says the investor is giving you money and you are giving them a security, an equity or a convertible. That's what a security means in this sense. So the convertible financing, your investment document is the safe or the convertible note. That's I give you money, you give me the security. That is the security. In an equity financing, this is what we call the stock purchase agreement. You give me money, I give you stock. So the stock purchase agreement has a few terms that can get negotiated and that you need to pay attention to, specifically the reps and warranties. This is where you promise that the state of the company is as set forth in these reps and warranties. For example, you might have a rep and warranty that says, I have not been sued. There's no litigation outstanding. Or I own all of my intellectual property. All the code that I need for my company is owned by the company or at least licensed to the company. And so those are the types of reps and warranties that you'll see. There's in an NVCA financing, you might have 30 reps and warranties. In a series seed, you might have 7. And so again, the complexity difference there is made evident. And you want to pay attention to those. If there's anything in a rep and warranty that is not true, maybe you have been sued, that's okay. You create what we call a disclosure schedule where you disclose something that is not true, an exemption or exclusion from the reps and warranties. So that is a very negotiated section of the documents and something that you as a founder need to review and pay attention to. After that, it basically comes down to the lawyers negotiating things and making sure what's in the term sheet is in the documents. So the amended and restated certificate of incorporation, this is your charter, your COI, your articles, as people call them. So this is where you're going to create the class of preferred stock that investors are buying. This is where you're going to authorize the shares you're selling, and you're going to establish all those stock-based rights, the economic rights, governance rights, conversion rights, dividend rights. Those are all in the charter, certificate of incorporation. So that's that document. Pretty standard. The protective provisions, they're going to be in there. So you just want to make sure that nothing is in there that wasn't in the term sheet. Sometimes you'll have lawyers try to sneak things in. You just want to make sure that they don't. So your lawyers need to review that and compare it to the term sheet. And then you've got the investor rights contracts. So there might be in a convertible financing, this is usually what we call a side letter, an agreement between the company and one investor, a side letter between those two that establishes the convertible investor's rights. In a preferred stock financing, you don't have that many side letters. You might have one with the lead investor. The rest of the investor rights are set forth in these 3 agreements: the ROFR and co-sale agreement, an investor rights agreement, and a voting agreement. Now, those contractual rights that we talked about, we broke them up into the company granted rights. Those are the investor rights agreement. The voting rights, those are the voting agreement, and the transfer rights, those are the ROFR and co-sale agreement. So you can review those pages and understand where they fall. But this is why the NVCA financing is so complex. You've got 5 documents that you've got to draft that have term sheet terms in them. Each of these documents can be anywhere from 10 to 30 pages. So you're looking at 100 pages of legal documentation that you want your lawyer to review. And that's why the NVCA is so much more costly than a SAFE, where you've got 5 pages. So that's kind of the difference there. Lastly, I'll just talk about these ancillary documents are documents you still need to close, but they're not really negotiated because they're so standard. A board and a stockholder consent to approve the financing and set up the board of directors that you've negotiated in the term sheet. A secretary's certificate and an officer's certificate, which is just stating that the financing has been approved, basically. Management rights letter, sometimes for the lead investor, this is like a side letter for the lead. And indemnification agreements for any new directors that are being appointed to the board. And then lastly, sometimes you will see what's called a legal opinion being asked for. Me as a lawyer will tell you legal opinions are worthless and they're very costly. They can potentially add $20,000, $25,000 alone to the cost of your transaction. And they are worthless. The lawyers will make it so that their legal opinion is so carved out and caveated that nobody gets any value for it. And so if you see an investor asking for a legal opinion, push back on it. It's worthless. You don't see it in most pre-Series B financings. And so if you do see that in a term sheet, you should push back against it. So once you've got your allocation requests from your investors, you've got your documents finalized and drafted, you go and collect your signatures, you collect your wires, and you're done. Well, you do need to file your charter before you close. You usually file the charter before you've collected the wires. So that's kind of the closing process. And that's it. You can get the money in the bank and you're off to the races. The last thing we'll just keep in mind, post-financing considerations. Well, you've got new board members you got to invite to the board meetings. You might have ongoing information rights like those quarterly financial statements that you've got to get out to investors. And then you've got preferred stockholders with certain protective provisions where you have to get preferred stockholder consent for certain actions. Again, these are in your charter. Make sure that you know what they are and just get that consent when you need it. And that is it for the post-financing considerations. And that's it for our presentation. Again, apologies for the time we lost early on with the technical stuff. Savvi, I mentioned it very briefly. We have a lot of tools that you can use, whether you're forming your company, raising money. We've got templates. We've got different support services and subscriptions that you can take advantage of. But that's it for Savvi. You'll also be able to schedule with somebody from our team if you want to with that QR code. If you want to get an intro or a demo of the Savvi platform, that QR code allows you to do that.
Perfect. Yeah. No, really appreciate all the great advice and, walking through everything you did today. So yeah, actually this same event link will turn into a recording that you can go back and watch. And we'll also send a follow-up email to all the attendees that includes the discount offer as well as any other, the video link and other information to go back and help, take all this and help support your ventures. So yeah, really appreciate everything you shared, Dan. And yeah, great interaction in the chat. I know, it seemed like the audience really found this valuable. So, I'm excited to do more of these together. And yeah, appreciate everybody coming out, participating, and, being part of our session today.
Thanks, everybody. Really appreciate it. Thanks, Jason.
Thank you.
It's good to meet everybody. Look forward to being in touch.
Sounds good. Thanks again.